This is Capital Ideas TV. Coming up, Parklawn is alive and well, the CEO on a transformational acquisition, and Russ Stanley of Echelon Wealth on Polaris Infrastructure. Hello and welcome to Capital Ideas TV. I'm Mark Bunting. Death is often an uncomfortable topic for many people, but it turns out it's good business. Parklawn has more than doubled its share price the last few years through steady organic growth and savvy acquisitions. The company is run by Andrew Clark, who owns a big stake in Parklawn. He also just struck a transformational deal for the company. Here's our chat with Andrew Clark. So Andrew, describe Parklawn for us, for those who may not know the business.
So Parklawn is Canada's only publicly traded cemetery, funeral, and cremation business. We are primarily a cemetery business. We have about 85% of our revenues come from cemeteries and the balance comes from funeral homes. We have operations in Ontario, Quebec, Manitoba, Saskatchewan, British Columbia, and then 4 U.S. states. So sizable operation. And
is it safe to say that this is a predictable business?
Highly predictable, although we quite often like to make the point that it's predictable, but it's non-linear. So the death rate fluctuates seasonally, and so it is predictable, but you don't exactly know when that's going to happen.
Is it a fragmented market, and are you also seeing a lot of family-run businesses with older people who want to get out of the business?
Yeah, it's highly fragmented. The largest player in the space in North America only has 16% market share. So there's lots of opportunity for growth through acquisition. And most of that activity comes in the form of retirement sales and family members, second, third, fourth generation selling their businesses.
So that demographic works in your favor, and the aging demographic works in your favor as well. And it's an uncomfortable topic for some people, but it's reality. It's your business. People die on a regular basis.
That's right. There's an inevitability to it.
So expand on that. I mean, what kind of metrics do you have on that level?
So we do know that there are approximately 6,000 or 7,000 funeral homes in the Canadian market. There's about 30,000 in total in North America. You know, we also know that the aging population is going to impact the cemetery business before it impacts the funeral business, because most cemetery sales are made in what the industry calls pre-need, so when people are still alive, whereas most funeral sales are made at the time of death. So we know that the aging population is going to benefit the cemetery business, which is predominantly a pre-need business, before it benefits the funeral, before the death rate benefits the funeral business, which is one of the reasons why we like the cemetery business in the first instance.
Let's talk about this Sabre acquisition in the United States. It gives you a nice footprint down there, and what can you tell us about it?
So Sabre is an extremely attractive business opportunity for us. There are 19 cemetery locations, 4 funeral locations, all of which are on the cemetery properties. And they're focused particularly on the Kentucky market, but also have locations in Illinois and Houston, Texas. So the predominant markets for Sabre are Chicago, Cincinnati, Louisville, and Houston, and those are all good markets for us. So a really nice footprint for us to expand upon our already sizable footprint in Michigan.
Some of the analysts are saying that this is a transformative, transformational deal. It's a real inflection point for you guys. Would you agree with that?
We do agree with that. I mean, this is we had a 3-year target by the end of 2019 to achieve $25 million worth of EBITDA. And with this transaction on a run rate basis, we'll be most of the way there. So a little ahead of schedule, but transformative nonetheless.
So you've always grown organically, and that's pretty steady. And you've been fairly consistent with acquisitions. You've also done 3 other tuck-ins, am I right?
That's correct.
This year?
Yeah. We've done 3 tuck-ins, 4 actually. We ended up doing 2 transactions in the Ontario market, just north of Toronto, broadly speaking, part of our Toronto cluster. We entered the BC market in February, and we also bought another B2B service in the Toronto market. So it is quite typical for us to go into a market, make an acquisition, and then bolt on from there.
That B2B or business-to-business deal sounds interesting. Could you expand on that in terms of Parklawn moving into sort of different services?
So this is, we bought a business called TCS, and TCS does outsourced embalming, call answering services, 24-hour answering services, pickup of deceased, and they do it predominantly for funeral homes, hospitals, and the morgue. City of Toronto morgue. And so for us, it was an in-source solution. We were using one of their competitors to do a bunch of that work for us. And, but it also allows us to provide other avenues to our existing B2B business, which is focused on cremation. So we now offer our funeral home partners more in the way of services.
Let's top some financials now. Andrew, you raised $80 million recently, so a lot of that was for the Sabre deal.
Right.
What else are you going to use that money for?
We have a number of organic projects in the pipeline. We have some mausoleum development opportunities that we're looking at. We have some on-site funeral home development opportunities that we're looking at, particularly in the Houston market. And we have an attractive M&A pipeline as well. It's you know, as we grow, the pipeline continues to become more robust, so we don't have any concerns that we'll be able to allocate that capital.
The dividend yield sits around 2.5%. Are you going to continue to, or is the plan to continue to grow it?
Our dividend has been steady since I joined in 2011. So while we discuss our dividend policy on a regular basis, our go-forward strategy in terms of capital allocation is not focused on growing the dividend. It's compounding our capital internally.
What's your payout ratio?
On cash flow, our payout ratio is about 42 or 43%. So so lots of comfort there.
Are you finding more and more institutional interest in Parklawn as you get bigger?
We've had a significant amount of institutional interest in the last 2 transactions we've done. Financings we've done, 70% or so institutional support from some well-known institutional players, both small and mid-cap in the Canadian market.
When you came on board in 2011, you took a 15% stake, is that right?
That's correct, yeah.
Where does that stand now?
My stake and the stake of that group that I got involved with then is about 10%. We've allowed ourselves to be diluted down a little bit in order to increase trading activity, which at the time was by appointment. So we've allowed ourselves to be diluted down, but still a meaningful position.
And there's still strong insider ownership?
There is indeed, yeah.
And just lastly, I'm curious about your journey with Parklawn, coming in 2011, and then ascending to the CEO position, growing it as you have. Here you are 6 years later. What have you thought of your journey?
Well, we didn't think we'd be sitting here at this point 6 years ago. We thought it would be a bit more plodding than it was. You know, the 2019 target of 25 million in EBITDA, I think, is evidence of that. But we've had a fantastic run, and we think there's more opportunity. And you know, to use a cliche, we think the best is yet to come.
And I said lastly, this is lastly, if you were to give a message to shareholders or potential shareholders, what would that be to sort of compel them to you know, hey, pay attention to us, we got a good thing going here?
Well, we like our business for a lot of respects. One because we're non-correlated. We're not really correlated to any other segment of the market. We have a safe, defensible balance sheet and a huge pipeline of opportunities. So we think it ticks a lot of boxes.
Insider activity now, where we look at officers and directors and the various buying and selling that they're doing in the companies in which they're involved, such as Semigenerations, which had a weak quarter. You see the stock dropping there, and analysts also cut the rating and cut the target price, but insiders with this company seeing this as an opportunity. In fact, recently buying 2.6 million shares. One director buying 117,000 shares, and then the CEO, the CFO, and the COO increasing their respective stakes in Semigenerations by 20, 37, and 30%. About a year ago, Peter Hodson of 5 Eye Research was our cover story in Capital Ideas Digest. In that issue, he talked about his investing philosophies, and he gave us a few stock recommendations. Today, Peter is in our Capital Ideas TV studio. We're going to expand on his investing ideas, and he's going to give us a couple of recommendations, Saverio and Photon Control. Here's our conversation with Peter Hodson. So, Peter, there are investors, value investors, for example, who, no matter what, will not pay up, will not pay a premium for any stock, for the Amazons of the world, so to speak. You're different. You're growth at a reasonable price, and you're okay with that. Why?
I would rather pay up for a great company than get any bad company cheaply. And so in my investment career when I was a fund manager, that proved to be the single best thing that I could do, is to pay a lot of money for a great company. Now, you don't just pay willy-nilly whatever you want. You have to understand why it's expensive. And so if your company's expensive because it's got a premium growth rate, or it's got no debt, or its cash flow is massive, or its free cash flow is massive, or it's got a high dividend ownership, or ideally it's got a competitive edge, Amazon might be the great example there, then it's worth a premium. And you have to decide if that premium is sustainable, and you have to decide if that premium is justified, and you have to decide what happens if, if people change their minds about that premium. But if you can get a great company, then I think you should pay up for it. You shouldn't want to nickel and dime your way, to the poorhouse. And I've seen a lot of people look at great companies, Netflix at $10. They say, okay, I'll wait till it's $8. And now it's the equivalent of $900, after the splits.
Right.
And so it's a situation where if you really like a company, you should like it. And you shouldn't have to say, okay, I'll wait for it to be cheaper. Obviously that helps if you can get it cheaper, but I've seen too many investors miss opportunities that way.
One of your winners has been Saverio, which you recommended to our subscribers about a year ago in the article I talked about. Remind me of the business. What do they do?
So it's really medical products for the elderly. So one of their early entrants in the industry was making lifts for vans. So if you're in a wheelchair, you have to get your wheelchair into the van, and it's sort of driver assist and things like that. So they've gone out and they've made some more expansions and acquisitions, and they bought a company called Span America recently, which makes medical beds and other facilities or other products that in your home when you're sort of, I don't want to say invalid, but when you're at home and you're not spending a lot of time outside, there's all these products that you can sell to that patient. Then they bought Shoppers mobile division. So again, for anything for mobility and vans and transportation. So they've done that in a very good job executing in acquisitions. Of course, the industry is growing, the population is getting older, and so their product offerings are starting to increase, and they've really shown a really good growth rate. And they've done it all while they've kept their balance sheet really clean. So it's a great little story with insider ownership. You've got the demographics. It is not cheap. It's 30 times earnings, and some people say, okay, that's too expensive. But last year, I think a little bit after our interview, they raised their dividend 30%. So they're you're paying you to go along on board with their growth. And now it's a bigger company, more diversified, much more U.S. revenue, and you're executing very well.
And insider ownership is still around 40% or so?
Yeah, they haven't, I don't think they've sold anything of significance, and some people get worried about insider ownership or insider selling, but we always look at what the price has done. So if you have, say, a 40% position in a company and the stock's doubled, you can sell a little bit and your actual monetary exposure is higher than it was before because of the stock. So, we'll grant some insider selling. We don't want to see them massively selling or anything like that, but around tax time, around year end, around option grants, we'll let some insiders get away with a little selling.
So you mentioned a lot of fundamental factors in Saverio's favor. What's the potential for the stock, do you think?
Well, I think it really depends now on their acquisition strategy. So their last acquisition, Span America, was very big for them. It was about $80 or $90 million US. And considering that the whole company size 5 years ago wasn't that big, it was a very big step. So I think it's good. It's going to add about 30% to their cash flow and their earnings, and the stock has responded accordingly. So now it's like, okay, now we've got Canada. They've got an operation in China as well that's potentially going to be very big. They want to go slow there because they don't want to blow their brains out spending money. But perhaps they'll do another acquisition in the US, and they're slowly sort of capturing market share of a growing market. And that's one of the reasons why we like it, is because even if they stay stagnant, you and I are getting older, and one day we're going to be using their products, and they've got a captured market for future business. So I think the stock has the potential to go above 20. It's gotten pretty close in the past, and one acquisition or a solid growth rate or another dividend increase. And of course in Canada, as the market cap goes up, more investors take interest, and you can get a higher valuation just because more investors now can buy you.
Let's talk about photon control. We interviewed the CEO, Scott Edmonds, here on Capital Ideas TV recently. Again, with this company, remind us of the business. They're in the semiconductor equipment manufacturing sector. They supply components, correct?
It's largely etching. So etching is one part of the semiconductor business where basically the wafer, things are stripped away from the wafer, leaving what you need behind. And so they do have an optical business in the oil and gas, and they have a sensor business as well, but it's really semiconductors that are driving it right now. So it's partially a company play and partially an industry play. So as you've seen from NVIDIA and AMD, I mean, the semiconductor market is clearly on fire right now. And in Canada, some of the semiconductor companies in the past, I mean, if you're as old as me, you had Genum Semiconductor, ATI, Tundra Semiconductors, they were all acquired.
Right.
There's really very little way to play the sector in Canada right now. So Photon is 95% of their business comes from the sector. They have 32 million in cash. It trades at 16 times earnings. Their growth rate is in the 80% range, and they're riding that wave of sector, the sector boom that's happening right now. So the stock's done quite well. I think it's up 45% or so as we speak. But there's lots of potential, and they just added a new customer that they've had to ramp up. And so they're kind of in the right place at the right time. So, okay, well, what are the risks? Their balance sheet's perfect. We could see insiders owning a bit more. We'd like to see a bit of insider buying there. Or their growth rate could slow down. And you know, there are always risks, but in terms of the sector right now, it's hard to see the growth rate slowing down, especially with a new customer that they just signed on board.
And in a year's time, where do you see the stock, do you figure?
Well, much will depend on the sector. The sector is very volatile, but it's hard to envision the sector turning over in a year. There's so many drivers of semiconductors right now. It's artificial intelligence, augmented reality, automated driving, cryptocurrencies. I mean, it's really hard to see the sector rolling over within a year. So you've got a 16 times multiple stock with a bunch of cash. So maybe they do an acquisition, or maybe they just keep growing at 50% plus. And I could see in the sector, a small cap, high growth company with no debt, I could see 25 times multiple on it. So you've got a 50% gain in the stock, even in a change in multiple. So much is going to depend on the growth rate. I don't think they can grow at the same rate as the last quarter. It was just a blowout quarter in terms of growth. But I think the growth rate will remain 40%, 50% for a couple of years. And that should get noticed. And if it can get to 200 million market cap, more investors might come on board. And they'll probably like what they see at that point. Because again, nothing's probably going to change. They'll still have a lot of cash. They'll still have an okay valuation. And they'll still be in one of the hottest sectors around.
We'll start with Helios Medical. We interviewed the CEO, Phil Deschamps, recently on Capital Ideas TV. And we had a cover story on this company several months ago in Capital Ideas Digest. Investors are getting excited that eventually it looks as if Helios will get FDA approval for its brain treatment device, and we're getting a lot of anticipation, and the stock has been breaking out lately to 52-week highs. We'll also take a look at IGM Financial. There is a school of thought that these kinds of asset managers are passé and you probably don't want to invest in them anymore, but that's not the case, as this stock is at a 2-year high, breaking above the 42 level. Now, conversely, 52-week lows. We'll have a look at Cara Operations. A big slide down here from the 30 range about a year ago, breaking through 2350, hitting 52-week lows. We'll also have a look at this company, Highliner Foods. You may remember a couple of years ago, this stock was doing very well, but not so much in the last year. Big drop here, and then 52-week lows breaking below 1675. Polaris Infrastructure is a renewable energy company that we featured as a cover story in our Capital Ideas Digest back in January. Russ Stanley is an analyst with Echelon Wealth. He covers the stock, has a buy rating on it, and says that Polaris has more than 50% upside. To find out why, here's our talk with Russ Stanley. We've talked about Polaris Infrastructure, Russ, in our Capital Ideas Digest before. Our contributor Fabrice Taylor really likes it. So let's hone in on the business. We know it's a renewable company, but what kind of renewable energy are we talking about, and where?
Polaris operates the San Jacinto geothermal power project, and that's a geothermal project in Nicaragua, located about 2 hours drive outside of Managua. Geothermal power basically involves pumping hot water and steam from underground and converting that to electricity, and then you re-inject the cooled water and back underground for reheating. What's unique about it is that it's not only renewable, but it's highly reliable, which enables it to be used as baseload power.
I understand the margins are really high.
Very high. The company's realizing EBITDA margins of better than 80%. So we like the story for that reason, and its high level of revenue visibility.
And why are they so high? Why are they at that level?
A big part of that is the project's location in Nicaragua. Comparing it to its closest peer in the US, their EBITDA margins are in the 50s. So we'd give that extra 30% bump to the project's location in a lower cost jurisdiction.
Tell us about production growth right now, and I understand that they're considering a binary unit. What is that exactly, and are they going to carry on with that?
Sure, it's like a binary unit's like a secondary power plant. So whereas the core unit just re-injects the cooled water back underground, the binary unit would take that cooled water and almost recycle it back into additional electricity for sale. That is something the company's been actively evaluating for quite some time. We don't think it's finalized yet. There is a potential for other areas for production growth, including a new production well that they're currently drilling and potentially a second production well to follow.
What's the dividend yield right now? What's the payout ratio, and can they continue to grow that?
So the current yield's about 3.8%. Payout ratio, we have it for this fiscal year being about 39% and going down to 28% next year. That's important because the company's target payout ratio is about 40 to 60%. So we think there's a lot of opportunity to expand that dividend. We think they can more than double the dividend over the next few years while staying within their target payout ratio.
Now, Fabrice Taylor has said more than once to me that he thinks that this company is essentially lining itself up to get taken out eventually. Is that the management team's goal?
I think that's a possibility. They also have a second project located to the northwest of the first project, so there's some optionality in there for a potential acquirer. It is located in Nicaragua, and that is perhaps a higher risk jurisdiction than other markets, but we do think that major infrastructure buyers are becoming a little more comfortable investing in developing markets such as Nicaragua, and so that is a possibility.
Okay, you're doing double duty today. Let's shift gears to a pioneering technology. We had the CEO, Kevin Callahan, in recently. You said you watched that interview. Impressive guy, interesting guy. Remind us about the main flagship product, which is the smart burner, and what it does.
Dull, boring, and old. Very, very old. The electric coil stove really hasn't changed in more than 150 years.
So smart burner is a really interesting product. It's basically a replacement burner for electric coil stoves. So it's something that anyone can pop in and replace the standard electric coil burner that you get on a stove. And the company realizes a price of about $140 per stove at this point. It's sold primarily through distributors such as Staples Business Advantage, HD Supply, and Interline. So good distribution platform and a product that basically anyone can install.
You're so smart.
Thank you.
And sexy.
Madam, smart is sexy. Look smart, cook smart, save smart.
What's the main catalyst for pioneering tech right now, and how important is that industry rule that's coming in 2019 whereby you have to have a product like this in your appliances?
Well, the company's done a great job of expanding or growing its sales into the aftermarket, but to date that's left the OEM market virtually untouched. So the safety standard changes coming in April 2019 are important because they'll effectively require manufacturers to install some sort of fire prevention technology on their stoves at the time of the manufacture. So that's something that could crack the market for the OEM market open for pioneering and could be the next leg up for the story.
Revenue is growing quite rapidly, 50% annually, and if not 80% in the last quarter. Tell us about that. Is it sustainable, and the profitability as well?
We think the company's been remarkably consistent on top line growth. They've guided to 50% this year. They did 50 last year and a comparable number the year before. So we still think that is sustainable, even if they were just targeting the aftermarket. So far they've done it really on the back of one product, the smart burner product. They are planning to launch another product for a complementary market later this summer. So that's something that could fuel additional growth in future years.
And lastly, Russ, I asked Mr. Callahan this: are you a logical takeout candidate? And he said, yeah, down the road, that could be the end game where an appliance maker, an Electrolux, a Whirlpool, whoever, he didn't name names, could take the company out. Does that seem like a logical fit?
I think so. These companies are going to, effectively be forced to install some sort of fire prevention technology on their products. To date, we believe that pioneering has the only game in town, so to speak. That makes them a logical candidate. It's still a very small company relative to the Whirlpools or the Electroluxes of the world. So it's a very manageable acquisition from their perspective, and could be preferable to trying to design their own product or simply trying to buy from pioneering on a long-term basis.
From the heart of the financial district in downtown Toronto, that's our show for this week. I'm Mark Bunting. Don't miss an episode by subscribing to our YouTube channel, and for more great investment ideas through our Capital Ideas Digest and our Morning Note, you want to subscribe to capitalideasresearch.com. Thanks again for watching. Thanks for investing like a pro. We'll see you next time.